If you're Gen Z and you think investing is just about chasing trends or betting on hype, you're already on the path to losing money before 2026 even arrives. Markets are wobbling, rates are unpredictable, and inflation still eats away at savings. If you don't know where to put your money safely right now, you will get crushed. I've spent over 7 decades in these markets. I've seen booms that made people feel invincible and crashes that wiped out fortunes overnight. And I can tell you this with absolute certainty. The investors who survive and thrive aren't the ones chasing the hottest stock tip on social media. They're the ones who understand that protecting capital comes before growing it. Today I'm going to tell you the 10 safest investments I would personally choose for Gen Z before 2026, and why most of what you see online is dangerously wrong. This isn't about getting rich quick. This is about building wealth that lasts, wealth that survives market crashes, economic downturns, and your own inevitable mistakes along the way. Let me start with something that should concern every young person watching this. Gen Z is entering the stock market at record rates in 2025. You're participating more than any generation before you at the same age. That's the good news. The bad news, your savings remain dangerously low, and your risk tolerance is often way too high for your actual financial situation. This combination of participation and lack of preparedness is a recipe for absolute disaster if markets get choppy. And trust me, they will get choppy. They always do. The question isn't whether you'll face a downturn, it's whether you'll be prepared when it comes. Here's what most young investors don't understand. You can't survive in this game if you lose your base capital. Think of your investment capital like the foundation of a house. If you crack that foundation by taking stupid risks early on, everything you try to build on top of it becomes unstable. Protecting your money comes before growing it. Always. No exceptions. I don't care how exciting that new tech stock looks or how many people on TikTok are talking about it. If you don't have a safety first foundation in place, you're gambling, not investing. And gambling is a fool's game with predictable results. Before we dive into specific investments, you need to understand 3 non-negotiable rules that have guided me through every bull market and bear market of my career. Rule number 1, know what you understand. Only invest in businesses or assets you truly understand your circle of competence. This is absolutely critical. When you invest in something you don't understand, you can't tell when it's overvalued, you can't recognize warning signs, and you definitely can't make rational decisions when panic hits the market. Your circle of competence protects you from hype and unpredictable losses. Stay inside it. Rule number 2, never use leverage. Never, ever borrow money to invest. I don't care if interest rates are low. I don't care if your friend made money doing it. Leverage magnifies risk dramatically, and it can destroy you even when you're right about the direction of an investment. You know what's worse than losing your own money? Losing borrowed money and still owing the debt. Don't do it. Rule number 3, prepare for volatility. Markets swing. They always have, and they always will. Some years they'll go up 30%. Other years they'll drop 30%. But you survive these swings by owning safe assets first. Build your foundation with boring, stable investments, and only then should you consider taking calculated risks with a small portion of your portfolio. Remember this, risk doesn't come from the market, it comes from ignorance. The more you know, the less you risk. The less you know, the more you gamble. Here are 10 safe investment I would venture in 2026 if I was a Gen Z. Safe investment has shown. Low-cost index funds. Now let's talk about the single best investment for most Gen Z investors. Low-cost S&P 500 index funds. I have advocated this for decades, and my opinion hasn't changed. For most people, especially beginners, buying low-cost S&P 500 index funds is the smartest move you can make. These funds spread your risk across 500 of America's largest and most successful companies. You get exposure to technology, healthcare, finance, consumer goods, energy, everything. If you can't pick individual winners, and let's be honest, most people can't, the best thing you can do is buy the whole field at low cost. You're essentially betting on American business as a whole. And over long periods, that bet has paid off remarkably well. Why is this safe? 4 reasons. First, broad diversification. When one company struggles, 499 others are still working for you. Second, historically strong long-term returns. The S&P 500 has averaged around 10% annually over many decades. Third, minimal fees. Low-cost index funds charge a fraction of what active managers charge, which means more money stays in your pocket. Fourth, they're easy to hold over decades. No complicated decisions, no constant monitoring needed. Here's my advice. Start putting money into a low-cost S&P 500 index fund every single month, no matter what the market is doing. Buy when it's up, buy when it's down. Just keep buying consistently. This strategy, called dollar cost averaging, removes emotion from the equation and builds wealth steadily over time. Safe investment, #2, U.S. Treasury securities. Let's talk about something even safer than stocks. U.S. Treasury securities, Treasury bills, notes, and bonds. Treasuries are about as safe as an investment gets. They're backed by the full faith and credit of the United States government. Unless America itself fails, you're getting your money back with interest. That's pretty comforting in uncertain times. There's nothing wrong with safety. Treasuries protect capital and give you peace of mind, and that's worth something. In fact, it's worth a lot when markets are chaotic and everyone else is panicking. Why should Gen Z consider treasuries? 3 key reasons. First, they preserve your principal. You know exactly what you're getting back. Second, liquidity. You can sell treasuries easily if you need cash quickly. Third, reliable income. They pay interest on a predictable schedule. Now, treasuries won't make you rich. They're not designed to, but they serve a critical purpose in any portfolio. They're the anchor that keeps you stable when storms hit. I keep significant amounts in short-term treasuries because I know that money will be there when I need it, no matter what happens in the stock market. For young investors, consider keeping your emergency fund and any money you'll need within the next few years in Treasury securities. The peace of mind is worth more than chasing an extra percentage point of return. Safe investment #3, high-yield savings accounts. Here's something that might surprise you. One of my favorite investments for Gen Z right now is a high-yield savings account. In 2025, online banks are offering around 4% annual percentage yield or higher, and every penny is FDIC insured up to $250,000. That means your money is protected by the federal government. Cash isn't exciting, but losing less sleep at night matters. Young people often overlook cash as an investment, but it's absolutely essential. You need accessible cash for 3 critical purposes. First, emergency funds. Life throws curveballs. Your car breaks down. You lose your job. Medical expenses pop up. Having 3 to 6 months of living expenses in cash prevents you from having to sell investments at the worst possible time. Second, short-term liquidity. If you're saving for something specific within the next year or two, a down payment, a wedding, in a major purchase, you don't want that money in stocks where it could drop 20% right before you need it. Third, peace of mind. When you have cash reserves, you can ride out market volatility without panicking. You're not forced to sell stocks during a crash because you need money for rent. That psychological cushion is invaluable. Don't underestimate the power of a solid cash position. It's not sexy, but it's smart. Safe investment #4. Certificates of deposit. Another safe option that Gen Z should understand. Certificates of deposit, or CDs. CDs offer locked-in rates, often around 4 to 5% in 2025 for short-term deposits. Here's how they work. You give the bank your money for a specific period, maybe 6 months, maybe a year, maybe 5 years, and in return, they guarantee you a fixed interest rate. You won't get rich off CDs, but they guard your capital extremely well. The return is guaranteed, assuming you hold the CD to maturity. There's no market risk, no volatility, no uncertainty. Why should you consider CDs? 3 reasons. First, guaranteed returns. You know exactly what you're getting when you invest. Second, no principal loss if held to maturity. Your initial investment is completely protected. Third, they complement the safety portion of your portfolio nicely. The strategy I'd suggest, ladder your CDs. Instead of putting all your money in one 5-year CD, split it among CDs with different maturity dates. Maybe put some in a 6-month CD, some in a 1-year, some in a 2-year. This way, you always have money coming available at regular intervals, giving you both safety and flexibility. CDs aren't glamorous, but they're predictable. And in investing, predictable often beats exciting. Safe investment #5. Dividend-paying blue-chip stocks. Now we're going to talk about individual stocks, but not the kind you see hyped on social media. I'm talking about dividend-paying blue-chip stocks. These are companies with steady dividends, long operating histories, and genuine pricing power. They're safer than speculative stocks because they have proven business models and generate consistent cash flow year after year. I like companies that earn money in good markets and bad markets and share that success with you through dividends. These aren't companies trying to disrupt industries or change the world overnight. They're businesses that sell products people need, regardless of economic conditions. Think about consumer staples, companies that make toothpaste, soap, food, beverages. People don't stop brushing their teeth during recessions. Think about healthcare leaders, pharmaceutical companies, and medical device makers. People need medicine whether the economy is booming or struggling. Think about household names you know and use every day, companies whose products are in your home right now. These stocks won't double overnight, but they're not designed to. They're designed to provide steady returns, reliable dividends, and stability during market turbulence. They're the tortoise, not the hare. And in the long race of wealth building, the tortoise usually wins. When you invest in quality dividend-paying companies, you get 2 sources of return: the dividend income itself and potential appreciation of the stock price. Plus, if you reinvest those dividends, you harness the power of compounding in a very tangible way. Safe investment #6. Treasury inflation-protected securities. Let me introduce you to one of the smartest inflation hedges available. Treasury inflation-protected securities, or TIPS. TIPS protect your purchasing power as inflation rises, which is absolutely key for young investors who will live through decades of inflation. Here's how they work. The principal value of TIPS adjusts with inflation. When inflation goes up, your principal goes up. When your principal goes up, the interest you earn goes up too, because it's calculated as a percentage of that principal. Inflation steals from you quietly every single day. A dollar today won't buy what a dollar bought 10 years ago, and it certainly won't buy what a dollar will buy 20 years from now. But TIPS fight back against that silent thief. Why should Gen Z investors care about TIPS? 3 compelling reasons. First, the principal adjusts automatically with inflation, protecting your real purchasing power. Second, interest payments rise as the principal rises, giving you increasing income over time. Third, you get the safety of U.S. government backing plus inflation defense built right in. For young people with decades of investing ahead, inflation is one of your biggest enemies. You might not feel it day to day, but over 30 or 40 years, inflation can absolutely devastate your wealth if you're not protected. TIPS are an elegant solution to this problem. Consider allocating a portion of your bond holdings to TIPS, especially if you're concerned about inflation remaining elevated or accelerating. They're not exciting, but they're effective. Safe investment, #7. Money market funds. Here's another unglamorous but essential investment. Money market funds. Money market funds hold short-term debt from governments and highly rated corporations. They provide safety with liquidity, meaning you can access your money quickly while earning a reasonable return. Most people call these boring. I call them sleep well investments. And there's tremendous value in sleeping well. When you know your cash is safe and accessible, you can be more patient and rational with your other investments. Money market funds serve 3 key purposes. First, parking cash safely between investments. Maybe you sold a stock and you're waiting for the right opportunity to redeploy that capital. Money market funds keep that cash working while you decide. Second, timing market dips. If you keep some money in a money market fund, you have dry powder ready when opportunities arise. Third, low volatility. Unlike stocks or even bond funds, money market funds maintain extremely stable values. The yields on money market funds move with short-term interest rates. When rates are high, money market funds become even more attractive. When rates are low, they're less competitive, but they're still serving their primary purpose: safety and liquidity. Don't overlook these as a component of your overall financial strategy. They're the foundation that lets you take appropriate risks elsewhere. Safe investment, #height, real estate investment trusts. Let's talk about getting exposure to real estate without the headaches of being a landlord. Real estate investment trusts, or REITs. REITs let you invest in real estate income without buying houses, dealing with tenants, or fixing broken toilets. These are companies that own and operate income-producing properties: apartment buildings, shopping centers, office buildings, warehouses, hotels, and more. Real estate can be safe if you treat it as business ownership, not speculation. That's the key distinction. You're not flipping houses or betting on appreciation. You're investing in businesses that generate rental income and distribute that income to shareholders. Why should Gen Z consider REITs? 2 main reasons. First, dividends from income-producing property. REITs are required by law to distribute at least 90% of their taxable income to shareholders, which means high dividend yields. Second, diversification outside stocks and bonds. Real estate often moves differently than the stock market, providing balance to your portfolio. The important thing is choosing quality REITs with strong properties, competent management, and sustainable dividends. Avoid REITs that are highly leveraged or focused on speculative property types. Stick with the basics: residential housing, essential retail, logistics facilities properties that generate consistent cash flow regardless of economic conditions. REITs give you real estate exposure with the liquidity of stocks. You can buy and sell shares easily, unlike actual property. For young investors who can't afford to buy investment property outright, REITs are an excellent alternative. Safe investment, #9, invest in yourself. Now we're going to talk about the single best investment you can possibly make, and it's not a stock, bond, or fund, it's yourself. I have said this repeatedly for decades, and I mean it with absolute conviction. Your best investment is in your own abilities. No market crash can take away your skills. No recession can eliminate your knowledge. No bear market can destroy your earning power if you continuously develop yourself. No one can take your knowledge away, and it compounds far better than most stocks. Think about that. When you invest $1,000 in a stock, you hope it grows to $2,000. But when you invest in yourself, in education, skills, certifications, expertise, the returns can be exponential and permanent. What does investing in yourself look like? Career-boosting education that increases your earning power. Maybe it's a degree, maybe it's specific training, maybe it's online courses in high-demand skills. Professional certifications that make you more valuable in the marketplace. Financial literacy so you can manage money wisely for your entire life. Here's something most people miss. Your earning power is your greatest asset when you're young. If you can increase your income by even 10 or 20% through new skills or education, that extra income every year for the next 40 years will dwarf almost any investment return you could get in the market. And unlike stocks, which can be volatile and unpredictable, your skills are yours forever. The better you become at what you do, the more valuable you become, and the more opportunities open up to you. So yes, invest in index funds and bonds and all the other things we've discussed, but never forget to invest in the asset that will generate all the capital you will eventually invest yourself. Safe investment has on zero. Patience and staying informed. The final investment isn't an asset you buy. It's a mindset you develop. Patience and staying informed. A long-term mindset beats reactive trading every single time. Gen Z investors who stay steady and stick to their plan will dramatically outperform those who panic sell during downturns or chase hot stocks during manias. The market transfers money from the impatient to the patient. That's not just a clever saying, it's a fundamental truth I've observed over 70 years. The investors who lose money are the ones who can't sit still. They buy high because they're excited. They sell low because they're scared. They constantly tinker with their portfolios, racking up fees and taxes. Meanwhile, patient investors who buy quality assets and hold them through market cycles build substantial wealth. It's not glamorous. You won't have exciting stories to tell at parties, but you will have money in your account. And that's what actually matters. Staying informed is equally critical. I don't mean obsessively checking stock prices or watching financial news all day. I mean understanding economic fundamentals, recognizing value, and making informed decisions based on facts rather than emotions. Read annual reports. Understand how businesses make money. Follow economic indicators. Learn from market history. The more you know, the better decisions you'll make, and the less likely you are to get swept up in euphoria or panic. Here's your rule. Don't panic sell. When markets drop, that's when patient investors get rich buying from panic sellers. And focus long term. Your investment horizon as a Gen Z investor is probably 40 or 50 years. What happens this week or this month or even this year barely matters in that context. If you're stepping into the market as Gen Z, don't be fooled by glitter and hype. Safety isn't boring, it's smart. It's the foundation that everything else is built on. These are 10 investments I'd trust with my money today, not because they make you rich overnight, but because they let you sleep at night. They're not going to get you on the cover of a magazine or give you bragging rights, but they're going to be there for you, steadily building wealth, protecting your capital, and giving you the financial security you need to live life on your terms. Your future depends on how well you protect what you have before you chase returns. That's the real secret most investors ignore. They're so focused on hitting home runs that they forget to protect themselves from striking out. Build your foundation with these safe investments. Get your emergency fund in place. Max out your index fund contributions. Understand what you own. Stay patient. Keep learning. And most importantly, invest in yourself. Do these things, and you'll look back in 20 or 30 years, amazed at the wealth you've built, not through luck or gambling or riding some hot trend, but through consistent, intelligent, safety-first investing. That's how wealth is really built. That's how financial security is achieved. And that's what I want for every young person starting their investment journey today.